All right. Good morning, everybody. Thank you guys so much for joining us. It is Monday, so you're going to get a little macro Monday coming right at you. We got ourselves John Walkup over here, a.k.a. Johnny Charts. Thank you so much for joining us, Johnny.
It's nice to be here. Thank you for inviting me, Noah. I always welcome this invitation with open arms.
You got a permanent invitation, John Walkup.
I know.
All right.
I do.
If you see John Walkup out there, you got to call him Johnny Charts. That's his name, Johnny Charts. I am Noah Rosenblatt. We are both with UrbanDigs. And this is Macro Monday, guys. And for those of you that are new to the show, we're going to start out with a little Manhattan real estate right over here. We're going to go through a couple of things. It's almost the end of June, so we're going to go through some June things as we go into July. We'll touch on a couple of macro topics that's going on up there, and then we'll try to circle back to Manhattan real estate at the end. We'll try to do all this in 30 minutes or less. We usually talk about stock markets and credit spreads and Fed fund futures. So none of this stuff is financial advice. Do not go day trading this stuff. Don't do it. Okay. There is a live chat. I think you guys are 20 seconds delayed. So Johnny and I are going to try to chill out. Just relax, Johnny. So we can answer some questions.
As they
chillax. Say. Let's get right into it, man. I want to start with my market ticker. I'm in my market snapshot section. You know, for those of you that don't know what I'm talking about here, I got an intelligence section, market snapshot section, and custom services section. All right. So we're in the market snapshot section, Manhattan, 1 month. I want to go over some of the 30-day measures right now. Supply is at 1213. That's over the last 30 days. Let's go take a look at when this. So this is May 31st to yesterday. So tomorrow is basically going to be the last day in there. You're at 1213. That's supposed to be at 1386. That's our average, 1386 for the month of June. So we're seeing the first month below the average in like the last 4 months. The previous 3 months were above. Johnny.
Yeah. I mean, look, but again, it's supply. It's been pretty much it's been following its normal seasonal track. I mean, for the last year or so, it's at a lower level.
Overall supply.
Average. When you add in overall supply, that average is a little bit higher, but generally speaking, it's trending a little bit higher than it has been the past couple of years. But I mean, really nothing to write home about in terms of supply.
Yeah. So it's tight. So expect supply to go down maybe a little quicker than it typically does. I mean, because if you think about it, right, we got less stuff coming on. That's number one. And you got 937 deals in contract, 719 off market. You add this with this. There's a lot more stuff going off the market, and there's less stuff coming on than typical this time of year. That's the equation I'm using in my head. So supply might fall a little quicker this summer. Johnny, let's shift to contract activity. 30 days. We're at 937. Again, we'll get the final print in a couple days. Final cleanup print. We are supposed to be at 1,055. 1,055 for the month of June. So we're coming in light on both deal activity and supply, John.
Yeah, and that's, I mean, you can point to a period in time in which that happened, right? We were sort of, the train was on the tracks heading into April, and then just kind of everything kind of slowed down, and it didn't come to a stall. Luckily, we're still very transactional. It's happening, just that the oomph left the market.
They pumped less coal into the engine.
There you go.
Yes. You know those guys that are. So that's what's going on right now. We're supposed to get, let me tell you what we're supposed to get for July. Supply for July is supposed to drop down to 1171, just to give you guys an idea. And deal activity for July is supposed to drop down to 917. Okay, from 1,055 is our average of 917. We're at 937, so we're starting from a lower point. So you got to get ahead of it, guys. The market's fading a little bit in front of us. You got to make those decisions. It's not the time of year, July and August, to kind of pin your hopes on. So I don't know, either tap the rental market. I mean, what are we telling our clients, right? Either tap the rental market, go off for a couple of months, or if you're going to go make a price amendment, do not tickle this thing. You know what I'm saying? Do not do little price amendments. You got a bottom line, go right down near your bottom line, leave a little bit in there, and that's the way to go get it, hopefully.
Yeah, and I just want to bring, I mean, we've already got a comment. Someone, Ab's asking, has anyone noticed much less activity at the open houses? Please let me know. So I wouldn't be surprised. I mean, that's what we're generally seeing. We're just seeing less activity in this market. And we are coming up to July 4th weekend, right? It's a Friday. So it's going to be another really quiet week, quiet weekend. And then what? July, what is that? The 4th, the 5th, the 6th. So it's like July 7th, 8th. I mean, we're going to start. Is it going to be a busy week after that? It's going to pick up a little bit, but I mean, we're firmly in summer now. So it's not like you can hang your hopes on, well, the buyers are coming back after July 4th.
Yeah. And this is like, you guys are 2 weeks ahead, right? So this is really 2 weeks. Oh, let me take that away. 2 weeks behind. So if it's quiet out there, then you don't have that energy, that coal being thrown into the fire that's gonna keep this higher. So we got to keep an eye on that. I mean, this spring season right here, it's looking more and more like last year. The only difference is we started out better in the beginning, and then we fell from a higher point. But it's like same shape, same. We're ending at the same level here, kind of a thing. We're actually down. And this has been up year over year for the longest time, and now we're down 5%. So we're losing some steam, guys. That's what's going on. It's starting to catch up to what you guys are telling me is going on out there. Okay. Questions, John?
Nope, all good.
Okay. Guys, we're going to pivot to the macro portion of the program. Let's go to credit spreads. Guys, I am going to creditspreadalert.com. John and myself built this for the world to use. This is tracking the difference between corporate bonds. Okay. And corporate bonds could be junk, could be high yield, right? We call it high yield or investment grade. It could be either category. It's a difference between corporate bonds and safe U.S. government bonds. That's spread. That's what this blue line is right here. Let me just click on max, okay, so I can just explain this to you. When the blue line goes up, that's bad. Very bad. Very, very, very bad. You don't want that.
Like that.
That's when this index, here, let me try to show you guys, okay? This index on top here is correlated to this blue line. And as this blue line goes up, this index goes to the right. And if you notice this little high thing, this is credit stress. High. You don't want that. Okay. For the global financial crisis, we got all the way to this very, very right point. So that dictates that top moment in time, right? Very, very bad. For the pandemic, I think we got to about like somewhere around here, right, Johnny? I think it was, say, 2.6 or 3.1. That was the pandemic. Right around there. Okay. And for the whole rate cut thing and for the whole Liberation Day, we got up to about 2.4, 2.5. For those of you that were around in April, you saw it, right? You saw it. Let me click on the 1 year. There it is. This whole thing here, but then it came down. And you look at the stock market, right? And again, I try to explain to you guys, the stock market is like the dumbest kid in the class. Am I allowed to say that, John?
I think you just did. So, I mean,
yeah, the bond market, you got the stock market. The stock market is typically following the bond market. And if one of them is wrong, it's usually the stock market that's wrong. Typically, it's usually the stock market. So as long as this is going down and credit stress is going lower, which we have, stocks are going to experience risk on versus risk off when this blue line rises. So that's why we follow this thing. And when I look at this, I know John and I have a slight disagreement in this, but when I look at this and I'm looking at credit spreads, it's just coming in. Like stocks just are going to keep going higher as long as this continues.
I mean, okay, so yes, we definitely have a slight disagreement on this. I tend to view this as, I mean, look, I don't want to fight the tape, but I get the sense that it's ticking down. I can't deny the fact that it's ticking down. I think, no, you even have the overlay from last week. You can see where we were last week.
Let me see if I can do that. That's where we were last week.
Yeah, so we've certainly ticked down. So I can't deny it. But my point is, though, that yes, I get that it's going to tick down, but I still think that there are risks to the upside. And you think about where the market is now, it's like at all-time highs. It's basically 8% or 10% almost higher than where it was pre-Liberation Day. So it's like that whole thing never happened, and yet credit spreads are still sort of quasi in the area. So they haven't really decreased. So I still think that there's tension out there, some frisson, to use that fancy word. So I think that could still come in. I think the bias is higher, but I mean, look, it's trending lower, so I don't want to fight it, but I'm just saying, watch out, because the Liberation Day, one of the things that happened post Liberation Day, I suppose, as well as COVID, as well as great financial crisis, is you see it go up, but you don't see it go up slowly. You see it go up fast. And that's really, really what I'm concerned about, is that we get too complacent, there's one little tweak, whether it's a trade thing, a geopolitical thing, some sort of Senate bill, like who knows what it could be. And the credit spreads simply move higher, faster, sharper, and to more because we've been so complacent in the last 6 or so weeks. That's kind of what I'm concerned about. But again, it's lingering at the back of my head. It's like, also I got to do the laundry, that kind of thing.
It's one of the, okay, I got a whole bunch of those. I got a whole bunch to say about it. First off, here's what you don't believe it, right? You don't believe this rally that's going on. It's like, you don't believe it. It's the most hated rally. It's the most hated rally because of who's in office, what's going on. And this is why I think it's going to continue to go up. It's like the pain trade is up and no one believes it. So it's going to go against you and people are getting short and they're going to end up buying and it's going to power it even higher. This is my opinion. I think it's a tradable thing, totally tradable thing. I don't think this goes on forever. I think there's like a little mini melt up going on. Doesn't end well, never ends well. But John, you're kind of right. I just want to point out, we're not really in complacent territory yet, though. Even though stock markets are at record highs, this could come lower. This has room to come down, like to these areas here, right?
It does, but I just get the sense that I think the macroeconomic world changed, and not necessarily for the better in April. And I don't think that's fully priced in yet. So I'm just curious what the new normal is going to be, and I just don't think we've reached it. So.
Okay, we will see. We will see. But as far as I could tell, when we're reading this tape, there is no caution here. This tells me risk on is going to continue. We're not seeing that parlay to Manhattan real estate, though. That's the difference here. These are liquid risk assets. We got our own thing going on in our little town here. So if you're expecting, well, why is risk going over there? Why is risk going here? Because there's stuff going on here. You guys know what I'm talking about.
Well, the other thing is, look, if it's risk on in the markets, why would you want to sink your money into Manhattan real estate? Just devil's advocate. Wouldn't you rather get, goodness sakes, had you invested in April, you'd be up like 20%. That's pretty good. I mean, it would take you over a decade to achieve that in some of the Manhattan real estate that we've seen. It's moving sideways for a long time. So not really a risk on play. Certainly there's risk, but not risk on.
I can't get out of my head how like a year and a half ago, I was doing a market update for Elegron or Sotheby's. I don't remember who. And one of the agents came on and just gave a very thoughtful, why would you not buy an apartment or sell an apartment and ask for Bitcoin or sell my apartment and buy Bitcoin? And I think Bitcoin was at like 40,000 or 35,000 at the time. And it did go down. It went down like to whatever for a little while. But like looking at it right now, it's like, Jesus Christ, look what's going on here. And no one believed it. Like what's going on in crypto is like, I think what's going on in the stock market right now. But anyway, that's a whole
I mean, look, you could have sold a nice home in Amsterdam for some tulip bulbs. You would have been like smiling at the top. That's all I'm saying.
Okay. Let's shift, guys, to Fed Fund futures, guys. We're going to tell you what you need to know about rates. Okay. We don't like to prognosticate. We don't like to tell agents in a Wall Street city talking to very smart investment bankers, what rates are going to do without knowing what the market's expecting. So let me just tell you guys what you need to know. First off, this is the Fed Fund futures. We are at the Fed Watch tool. I am clicking on this probabilities tab on the left to get to this table. This is what the market expects, the Fed to do in the future. If you look at these meeting dates on the left side, this is all the future, right? It goes all the way out to December 2026. Ooh, back to the future, right? We are here up at that level. And there's been some change, Johnny. There's been some change going on. I don't know if you noticed mortgage rates ticking a little down lately, but the next Fed meeting is July 30th. And you got 81% chance that we're going to just chill out, pause, stay right in that same category for one more session. But then you got September, quarter point cut, 74%. That keeps rising, John.
Yeah.
That keeps rising. October, quarter point cut, 58.7. That keeps rising. December, quarter point cut, 49. That keeps rising. So you got now 3 cuts, September, October, and December, of which only one of them is 74.3%, which is, I think we can kind of start to count on that September cut. I don't know about the other two just yet, John.
Yeah, look, I feel, I guess you and I don't know if we disagree on this. I kind of get the sense that we may see one cut, but I don't necessarily right now see the rationale for anything beyond that. Given I mean, look where the economy is. It's proving to be pretty resilient.
Yeah.
And we still are I mean, look, inflation is, you can think it's under control, but again, the whole Liberation Day, we are not, it's going to take a little while for whatever happened to kind of shake out through the data. So I get the sense the Fed is going to be waiting on data and waiting on, actual results from the past to kind of get a sense of, are we going to cut beyond September? So, or rather July. Sorry, where's the next cut? September, right?
September.
So, yeah, September. So I get the sense that we might see that September cut, but I don't really, at this point, I don't see anything beyond that, because I think the economy is doing great. And look, I mean, all caution aside, I'm just talking on the macro side. I think it's, it's doing great for some, it's not doing great for others. But when you look at the mortgage rate trajectory, it is trending lower. I mean, I think the jumbo rate's at its lowest point in several months. So it's not low, but it's lower, and you're working its way down. So that's a good sign to see. Look, I think we're sort of working into a new normal here, and I get the sense several weeks ago we saw a lot more white to the left of those blue bars, and now it's kind of all kind of coming back and centering around a few rate cuts, of which I think we might see at least one this year. I don't think we'll see more.
I kind of agree, and like my gut, just I'm not predicting anything. I feel like somewhere in this range, we're here now, and I feel like we're headed somewhere into this. Like I feel like neutral rate is right around there. The Fed could cut right now. The Fed could cut. Like there's definitely reasons to cut, but there's no reasons to take it all the way down to year kind of thing, as John said, with the economy and stock markets at record highs and
that would be a
potential tariff inflation. Yeah, that would correct.
Be careful what you wish for. That one.
So this is like your neutral range. Like this is kind of where rates kind of should be, but we're up here a little bit. So we need to kind of get there. But John's right. Once you get below this level, this is like stimulatory cut level down here. So if you get down to these cuts, that means that there's bad reasons why the Fed's cutting. Very good point, John. Look at you.
Nailing it today. What can I say? I had my Wheaties.
All right, let's shift to show you guys a couple of macro charts really quick, guys. Inflation, I mean, it's all, take a look at this chart, guys. There's a couple of blues. I know it's monochrome. Take a look at the light blue and go to the right side. Take a look at this slightly darker blue and go to the right side. That's housing and services. And then take a look at the dark blue. That's goods, that down there. And the Fed is right. You can see the target that the Fed has, kind of a thing for these things. It's all housing and services. It's not goods.
Yeah, but goods hasn't filtered through yet. I still think that we have a couple months of that. When that good enough, you have to kind of judge it in September, October, or even August, but just get a sense for what has happened with the tariff. So I think that it might be a preliminary look on the goods. But yeah, you're right. I mean, it looks rather tame on the goods front right now, and it seems like most of the inflation is contained in housing and services.
Housing and services, and we'll get to housing in a second. But I feel like housing is like, you're not going to really see a huge correction maybe in Manhattan, but like, some of the markets outside Manhattan are correcting. We've been talking about that here on Macro Monday. But let's just pause. Let's just show you one more macro chart, guys. Look at the brown line on the top, guys. Focus on the brown line at the top. That is entire labor force unemployment, that brown one. Okay. Then you got these lines above it and below it. The one above it, the orange, is recent graduates unemployment. Right. And the one below it is college graduates. Right. So I thought this was interesting. John, you picked out this chart. I picked out this chart. We both kind of picked out this chart. And what did you see here that you thought was interesting?
Well, so you have the two lines, recent graduates and college graduates. Recent graduates is anybody that's age 22 to 27 with a degree and is out of work. They're looking for jobs. That's rising. That's not great. I mean, for housing in general, you want these people to have jobs. You want them to be part of the pool of either people looking to buy or looking to rent. And apparently, they're really not going to be part of that pool without a job. So that's one. So sometimes you think about what's happening with rents, and I know we're going to be talking about that later. But sometimes the cure for higher prices is higher prices. And I get the sense if you have a pool of young people who are not able to get a job, and whether that's AI or who knows what the issue is, that could serve to sort of bring down some of these rents. And it's a push or pull situation, but either way, it's going to filter through the housing in one way or the other.
Yeah. But it's generally at a low level, though, right? I mean, even outside of the recent graduates, of course.
Yeah, I'm interested in the recent graduates number because that's the one that's rising, and that's the one that seems like it has a much more of an upward trend. And so I'm wondering, is that something to how concerned should we be about the fact that it's getting harder and harder? I mean, look, going back to what is that, 2022? Like, look, there's a huge spike post-pandemic. I get it. But since 22, that line's been working its way higher at a faster rate than the others. So it's interesting.
Okay. Yeah, I thought it was interesting as well. But meanwhile, when we take a step back, yes.
And just on that, Scott writes in, he says they're still coming to New York, and the moms and dads are still buying the apartments for the kids are helping with the great transfer wealth. Totally true. I get that.
Yeah.
But I guess the general question is, how much sustainability is there if this number keeps rising? Just look, is it going to affect things tomorrow or next week, next month? Probably not. It's just something that I think I'm cautiously watching.
I think it's just more macro. I mean, this is Macro Monday, guys. I don't want to just focus everything on New York City. I mean, that's what the point of the show is, just to have a touch base of what's going on a little outside our world so that we have a general idea and then we could talk about our markets kind of thing. And speaking of that, again, bigger picture, guys, this goes all the way back to 2003. You got a bunch of data here, guys. Foreclosures and bankruptcies, foreclosures are rising. Bankruptcies aren't, they're falling. But look at where we are. Look at where we are in the whole grand scheme of things. It's just not a problem. It's not going to be the cause of any kind of crisis. That's for sure.
Yeah, I like this chart for that reason. I think it's comforting to think that all of the regulations that went into behind, mortgage lending after the great financial crisis seem to be working. But again, I think, post 2022 that once we came down off that high, we haven't seen the sheer number of mortgages written. And I guess at higher rates, you probably have to be a little bit stricter with your lending standards too, simply because that payment's going to be higher. So net, I think this is a positive sign. So I'm I'm cautiously optimistic. I'm using that phrase a lot these days. I'm optimistic that if there's problems in the economy, hopefully they're not going to be stemming from crazy mortgages and people owning multiple homes just
yeah. Yeah, it's not going to that. If there is any cycle down or a risk off or whatever you want to call it, it's going to be a different shape and form of what we've seen in the past. I just don't see. I mean, this messed a lot of families up, man, and a lot of kids saw that, and now those kids are all grown up and buying houses. They're going to be more prudent, and you're right, the regulations that too. So it's just different. Yeah. It's just very, very different.
That's a great point. And there was an article. I don't want to say Wall Street Journal, maybe New York Times. I don't know, but it was comparing the savings habits of millennials versus Gen Zs. And apparently Gen Zs are starting earlier, saving more. And I think millennials, to your point, Noah, they witnessed a lot of this. They saw savings just become completely eradicated by, people losing homes and stuff. And they've been affected.
It's terrible.
So Gen Zs who maybe did not have that as a central part of their upbringing are doing a little bit more saving early. So Scott writes in that like real estate comes in these big cycles. You get these big ups, big downs. So yes, there's another cycle on the way. We just don't know when it's going to hit big.
Well, I know you don't like me talking about. Oh, did I do something here? I know you don't like me talking about Noam Newman's when his webinar, but it could start if the rental market continues doing what it's doing. That end game is the sales market having a cycle up. So.
I think you're right. I think there's a cycle. I was hoping this spring we'd see it, and we got all the indications that we might see an upcycle start again in the spring, and then it kind of just like the air went out of the balloon. So maybe we'll see it coming again, but for right now, didn't happen this spring.
Didn't happen. Meanwhile, guys, last chart on the national housing market. Zillow put out their updated May. They update it, every month. It's kind of looking at sales price kind of thing. So it's a little lagging, right? So they're talking about the hottest markets. And of course, I mean, look at that big bubble for New York City, or I guess the New York City County. But it is really, I mean, take a screenshot of this. It's such a fragmented regional marketplace. And there are a lot of housing markets that are well into a downturn right now. And it's actually the first time in like 6-7 years that national housing price numbers are actually declining for starts of the year. So it is different. It's just not really hitting us very much. They have us as kind of strong. And what's interesting is when I look at the price data is strong. It's strong. It's starting to roll over a little bit, But like, if you signed a deal in April, like when did the Liberation Day really hit us? Right, April. But early April, we were at our peak, right, John? Like we were at the top of that move through March, right? Climbing. Early April at the top, and then we started falling. So the real shift in prices for our market is really deals signed like May, late May, early June, yesterday, kind of a thing. And we're not going to get that price discovery for 3 months. So keep that in the back of your head. I'm seeing strong rental rates and strong pricing. That's what I'm saying.
Yeah, I think I love charts like this because I love seeing different colored dots all over the place, and it makes me think that like it's a dynamic chart and stuff is happening.
Ooh, pretty colors.
But again, it is pretty colors. But you know, if I take a step back, you know, you look at this, and objectively, what it's saying is New York is a hot market, Florida's a cool market, right? That's kind of what it says. California's a little bit, it's warmer, but it's not doing as well. The Northeast is on fire. But if you look at the real time on the ground here, it's not as clear cut.
Correct.
So I like to take these with a grain of salt, right? Where's climate? Climate has worked its way down over the last few months. Pulse is just kind of hanging out at a lower low. So it's like, you know, is this market doing better than it is in Miami or St. Petersburg or Austin? Probably. But again, I mean, it's still tough out there.
Let's take a look. You're right. Let's pivot back to Manhattan, guys. We're in the ending portion of this program. If you got questions or talking points, put them up now on YouTube. This is our listing climate. This is March. That's April. That's May. We're about to get our June print. Where do you guys think the June print's going to be? You guys think June went up? Think June's going to do something like that? You think it's going to be down? Where do you think it's going to be?
Are you asking me? I think it's probably going to be a little bit. Well, I'm telling you, I think it's going to be a little bit lower.
So you think it's going to be one of these kind of guys?
I think I would think we'll still be in the neutral range, but I think it's just working its way down. I mean, that's typically what happens, you know, in this sort of scenario. I mean, June's usually quieter than April and May, so I wouldn't be surprised. So, people are chiming in down.
Okay, one second. This looks at listing flow, guys. Listing flow. This looks at the more listings that are successful than going off market, this goes up. The more listings that go off market versus going to contract, this goes down. So this is showing us the deterioration climate. Go ahead, John.
No, I'm just thinking to myself that I'd love to be able to, we should be able to work this into like a more active measure. That's almost like a daily measure based on what has come in. I'll tinker with that.
We tried looking at that weekly and it was too noisy.
The gears are turning. The gears are turning. I've got an idea. And then George writes in with sort of, I guess, the $1 million question over the last couple of weeks. How do you think the mayor race and the outcome will factor into the future of NYC real estate?
I'm shocked that this topic came up.
I know it's really a sleepy town, sleepy election. No one's paying attention.
We try to keep this apolitical. I'll tell you that much. We try to keep.
Well, I guess I have thoughts on this. Look, there's a lot of hand wringing right now, and it's deservedly so. I think sometimes it's you know, this is the policies that are talked about represent drastic change, and I get it. And there's hand wringing, but at the same time, I mean, that sort of populism I think is very charismatic to a lot of folks. I wouldn't be surprised if it turns NYC into sort of a young people mecca, brings people to the city because they want to be a part of this change. So I don't want to say the phrase because I've said it so many times already today, but I will say that I'm interested to see. This is going to be a very interesting race in November. I'll be very curious to see, after we've had some sober analysis of policies, I'm curious to see what the final look is mid-October before the election, what actual policies are looking at, what cabinet they're looking at, that kind of thing. So
yeah, it's going to be telling. I'll tell you what, it's going to be really telling because now you're going to really see whether or not New Yorkers are concerned about this because the voter turnout for that primary was low. And now it's a hot topic and everyone's talking and, you know, soon it's going to be all right, vote time. And anyone that's concerned about this, you know, may obviously go and vote where maybe they wouldn't have, I don't know. But I think turnout's going to be high in this vote. So now you get to see what the New Yorkers want. So let's just see what that is. I don't want to get too deep into political. I want to keep it on Manhattan real estate. But if he does win, I don't see anything good for our real estate market. I don't know. I just don't. I don't. If I was an investor, I don't know. I'm probably going to just look away for 4 years. That's my thinking.
Yeah, I'm not sure. I think this is a very dynamic city that in many cases real estate somehow manages to transcend politics. I've been surprised many, many times, just like the stock market can transcend economic reality, right? So,
okay. Well, we'll see how it plays out. We'll see how it plays out, guys. Let's get back. I want to show you a couple things before I run out of time here on Manhattan real estate. Okay. Look at, guys, this is the shift that we basically had. This is the shift. We were there. We're still in the neutral zone, guys. Sellers market up here, buyers market down there. This whole entire thing that we went through in the last couple of years between the volume trap that was this whole period, the recovery, which was to this period, and now we're back at this period again. So if you want to say, oh, how it feels, this is supposed to show you how it feels. It's not quite a buyer's market, not like it was during the pandemic at least, but we are at a slightly worse place. Now for rentals, okay, I'm just going to go breeze through this really quick. John, if there's comments, please interrupt, okay? For rentals, guys, I got this set up before, so we didn't have to do it. Here's your updated rental thing, June 11th to yesterday. Okay, is that yesterday or is that today? No, it's yesterday. That's today. Okay, so today. Sorry, excuse me. June 30th. It's today. 730. This is Revenue RLS, guys. I mean, we say our sources out there. We have Revenue RLS, Brooklyn MLS. I do not have open listings. I do not have for sale by renter or for rent by owner, whatever it is. I don't have those. Okay, so these are directly exclusives. That's what we're measuring and tracking. The latest data is putting us at 5350. Okay, that's where we're at. So
yeah, and you can compare that to the first 10 days, right, of June 1st to 10th. I think there were 900 something listings that came out with a median ask of all of those about 4750 or something like that. So
let's take a peek.
It's been what, almost 3 weeks, and we haven't even generated the number of listings we had in the first 10 days, and the asking rent for those is higher. So look, again, this is a subset of the New York City rental market, right? We're looking at revenue listings, RLS. So they obviously are coming from brokers, the brokerage community. They're not open listings. They're not, landlords on Street Easy, that kind of stuff, just advertising. But it is an interesting slice to look at the trends, right? Fewer listings, higher price.
Smaller apartments, higher price. This is June 1st to 10th. This is 11th to today, this morning. There you go, guys. That's how I do it. I'm just to let you know, you guys could do this, right? Just to let you know how it is. Save and add more. I'm just using this historical status, this current status is right next to here, right? Typically, this is current inventory like that. Click on that and use the historical status search down here, and you can do this yourself. Okay. And finally, a couple of charts. You guys have been asking us to talk about this. I'm just putting this out there for you to take a screenshot. I don't care. Get the information so you can talk to your clients. Johnny updated this, like, I don't know, about a month ago, but it's still valid. The renovation gap that we're seeing is still 16%. It seems like the market is continuing to penalize anything that needs a redo. Even if you renovated it a decade ago and it still looks good in the seller's mind, the open market out there is just like, I want to redo it. And they're penalizing. But this is this. Okay. John, any thoughts here?
No, I typically there is a spread. It's narrowed, I guess, since the peak time, but at some point it was close to 30%. It was a big gap, right? That was during the pandemic. There was very little supply, and the only thing buyers wanted was something they could move right into and just bring their toothbrush, and they did not want to bother with crazy timelines, rising costs, summer work rules in general. Nothing that they were paying through their nose to get it. Now a little bit less so. And typically what happens when the market really, really rallies, as you can see at the beginning of this chart, they'll actually catch up because that price per square foot, I mean, it's just give me something, give me anything. I don't care what condition it is. I need to have something. So we're not quite there yet, but they've narrowed a bit.
Yeah. And finally, guys, I thought this was an interesting chart. This is something John and I do every once in a while. It's a specialty kind of a chart. I like it. It's renovation decay, right? Decay. Look at the bottom, guys. Years since renovation. From a brand new renovation on the left, sometimes you get over what you put into it. Sometimes really nice renovations. Once you get to like 5 years out, you're like, you're only going to get like 60, 70, 80% of your investment back. And then once you get to like year 8, 9, 10, you're kind of getting approached. So you're not really getting much money back. This is kind of what we're seeing out there. So I just wanted to put that out there. It's a conversation to have with clients and let them know what's going on, because every seller just feels like the renovation they put in doesn't matter how long ago it was. It doesn't matter if buyers wanted to redo it. It should get rewarded. and the market's just not cooperating.
Yeah,
So,
we've even seen some apartments that have been renovated about 10 years or so ago, never lived in, and they're still getting penalized simply because there's a slight shift in style. Like maybe it's, who knows, but it's just it's hurting everybody. And just to clarify, a couple questions. How do you tell what's renovated or not? Is this condos only, et cetera? So basically, we analyze every single listing to kind of get a sense of the state. And the second is, yes, we're looking at condos because we want to do price per square foot. Because if we looked at co-ops and we're going on medium price, it gets really, really tricky to kind of understand. And sometimes those numbers get all over the place. So price per square foot is a very good apples to apples comparison for us. So we try to limit it to condos with price per square foot. If there's a co-op with square footage in there, sometimes we'll look at it, but generally speaking, this sticks to condos.
yeah, and I would say, guys, this is a general guide, guys. Come on, this is not a one size. It's a one size kind of. You can't just paint a broad stroke. Every renovation is completely unique from another renovation. You guys know what I'm talking about here. Some people put renovations in that just the market just does not really, cooperate with in terms of making money on. And other types of renovation are just blow me away gorgeous. And they do. The market likes that. So this is just a general concept. If somebody did a renovation 15 years ago and they're expecting their money back, they're probably not going to get it back. And that's what this chart is showing you. Okay, guys, it's that the brand new is like the last couple of years. That's what's going on today. Okay.
Yeah, and that's when we're seeing the premiums. That those first, if you renovate it, put it right on the market, maybe you'll see a premium. I mean, it's very, very short lived. I mean, time's a real killer on premium. So the longer you go, you'll notice there's a 0% line. That's recovery of that renovation. So once you get below that, people are saying, I don't even care you renovated. I'm going to have to put more money into this. So if you spent $300,000, I'm going to take off $400 from your price.
That's what's happening.
So
that's what's happening. Okay, guys. All right, we're at the end here. Any final questions, Johnny? We'll give you guys the last few seconds for final questions. Other than that, a couple of housekeeping, guys. July 4th is Friday. We are going to be taking off with our families here, so there is no Friday update on July 4th. Tomorrow, if you're around, guys, this is a great workshop, Negotiating Tactics for Buyers. It's a very engaging, open conversation. I would love to see you guys there. Outside of that, final questions, John?
No, Carol writes in. She says that going back to the renovation decay, she thinks it's interesting. It could be due to people buying new dev. And she did research on the condo luxury market on the Upper East Side, especially the luxury market, and the number of new dev sales is very significant. So yeah, look, it could be because you think about a new dev. What is that? It is essentially a fully renovated turnkey property, right? You have a punch list walkthrough as opposed to like walking in and water doesn't come out of the faucet. So it's a completely different asset class than resale is. So I can understand how alluring it is, especially when price per square foot is really probably not the highest concern for some people. Like, oh, 3,000, 4,000. Well, what is it? I just want to be in this location. Just tell me what the price is.
I got to tell you, the new dev market's going to be really interesting to watch over the next 24 to 36 months and what it's going to look like in 2-3 years from now. It's probably not much of it. I don't know if building's really starting to tick up tremendously right now. And even if it was, I could see it in 4 or 5 years. So very interesting times in new development. Good point. Thank you, John. Well, thank you guys. All right. We're over time here. Sorry to take up your time, but thank you, John. I appreciate it. That is John Walkup. I am Noah Rosenblatt. This is UrbanDigs, and this has been Macro Monday. And hopefully I'll see you guys tomorrow. Enjoy the day, everybody.
Happy 4th of July, everybody.
Happy 4th of July. Good luck out there.